So I think it's happening again. I think big money is getting the data before we are. The data that I'm referring to is your GDP report coming out tomorrow morning and your durable goods orders report coming out tomorrow morning. These two data points are the biggest data points that we have gotten so far since the Fed's 50 basis point cut. Now, we have gotten some data like service PMIs, manufacturing PMIs, Richmond Fed service and manufacturing data, all of which has been decisively negative. So tomorrow's data holds a little bit more precedence now. And markets briefly in the beginning of the trading day hit a new all-time high before subsequently, well, falling. And I think it's no surprise. I think it's happening again. Now, as I posted here on the channel about 2 weeks ago, that one individual on CNBC said it. The one thing that is like, you shouldn't say if you're someone on Wall Street, that the data was in fact getting leaked before we have gotten CPI reports, the last two really. That news with NVIDIA, you might recall that pretty vividly. NVIDIA was down 9% for seemingly no reason. And then in after hours, news came out that NVIDIA was sent a subpoena. Like, big money is decisively, without argument, getting big data reports before we do. Now, what does today's decline in markets signify for tomorrow's data? What are the expectations for tomorrow's data? And just how important could tomorrow's data be for broader markets? We'll get into that in this video. And let me start with this. I think the data tomorrow will be very important for markets. And judging off of the decline we're seeing in markets, I have to imagine the data is not as good as what the markets are hoping for. Now, you got to think about this quite logically. When big money is getting these data reports before everyone else, this is BlackRock, Vanguard, State Street, Jane Street, Sequoia, this is Citadel, this is Virtue, the market makers, right? Systemically important firms are getting the data before everyone else. Like, your average hedge fund on Wall Street doesn't have the data, right? It's the guys that are important that you cannot have fail in this this cutting cycle with the Fed. If you were to see, like, a big firm start to fail, that could be that 2 standard deviation black swan event, maybe 3/4 standard deviation black swan event. Honestly, they don't fail all the time. That could push you into a recession. That's the last thing the government, the Fed, or anyone else wants to see happen at this stage in the economy. Now, again, back to what I was saying, thinking about this logically, when those big money firms are getting the data, they are going to position ahead of time for it. And that's why we've seen those weird moves, the day before a data report comes out, or the day of, in the case of NVIDIA, or with the Fed's 50 basis point cut. Like, I was very vocal about that here on this channel, that the Fed was going to do 50 basis points. They already had leaked that to Nikki Leaks. They had leaked that to big money, and it happened, right? That was proven correct. Now, I think the data was leaked for tomorrow morning to big money. Now, when big money gets this data, they hedge for the downside, okay? If they're super long, they hedge more for the downside. I don't think big money, the systemically important firms, are too exposed to the upside right now. And I'll tell you why. It's obvious we are heading into a recession or some kind of slower growth environment where it's going to be hard to meet earnings expectations. Like, earnings expectations are through the roof. They've actually started to come down now over the past 2 days. We haven't got that reflected in markets yet. So I'll show you that here in this video. But I think your big firms, they're not taking the risk right now for limited upside. Even if things go perfectly as planned for markets, there is very limited upside here. That's the fact of the matter. That's definitive, decisive. If valuations don't matter, then that's another thing, right? Then markets can keep running. And I will ask you that here in this video as well. Do valuations matter? Because you're right up there again with price to sales ratios where you were at in the dot-com bubble or at the peak in 2021, right? Does valuations even matter anymore? I think that's a good question that we should actively be asking, because markets are acting as if valuations and or risk does not matter anymore. Okay, but I don't think, again, these big systemically important firms are too leveraged to the upside. So I actually don't think there needs to be too much downside hedging. Now, yes, there's going to be some, obviously, because these guys own a lot of stocks. They have massive, portfolios, and a lot of them are market makers, right? So they're going to try to burn premium. They're going to try to, raise premiums. And you're seeing that in the options market today because they want to collect as much premium as possible so they're not on the wrong side of trades, okay? And I think that it explains why markets, yes, they're having the biggest red day since the Fed cut rates 50 basis points, but I think it explains why we're not having a really, really bad day today, because I don't think a lot of firms, big firms, smart firms, are super leveraged to the upside here. I think they're not. Okay, I think they're starting to grow cash. We will see this more when we get 10K, 10Q filings that come out, earnings, right? We'll know a little bit more. But even like Warren Buffett and Berkshire Hathaway, they're not that leveraged to the upside right now because there is limited upside if things go perfect. And the odds of things going perfect are not that high. Okay, so I think that's what explains kind of the, we're not getting a huge drop versus some of the other leaks that we've seen leading up to the Fed, where perhaps we had seen more of a downside bias. Like the first week of September, you fell 4%. I think a lot of that was big money getting ready for the Fed and repositioning and allocating their portfolios in different directions. So I think the data was in fact leaked today to big money. In fact, I don't just think that, you almost know that, like almost with a certainty. Okay, just judging off of what we've seen over the past couple of weeks. I mean, even that guy on CNBC like 2 weeks ago said, quote, "It seems like for whatever reason, some people are getting the data before others." I shared that clip with you guys here on the channel. I think most of us agree the data is being leaked. So if you want to go back and find it, just type in the channel leaked data, confirmed leaked data, and you'll see that. It was like a week or two ago. Not a big deal. I think we all understand the data is being leaked. Now, the data that we get tomorrow is durable goods orders month over month. Now, last month we were at 9.9% positive. We are expecting negative 2.6% for tomorrow. That's actually not bad. If you come in at negative 2.6% after a positive 9.9% month, it's really not bad. So on net, up 7.3% is the estimate over the past 2 months. That's actually really strong. The risk here is, and what this market reaction today is kind of telling us, is that you could see a bigger negative number. I think anything more negative than like -4, -5 is going to be seen as really bad. God forbid we come in at like -10, right? That would be a bigger problem if we're actually negative now over the past 2 months. I don't think that's going to happen, but I do think a -4, -5 number could definitely be on the table for the data coming out tomorrow morning. And I don't think Wall Street is going to like that in light of some of the recent data that we have gotten that shows the economy is just in a bad place, especially manufacturing, but not just manufacturing. Yes, manufacturing output and volumes are starting to fall, but it's now the employment area of manufacturing, which is really factory jobs. Factory jobs are starting to be cut a lot, and that is not good. Now, tomorrow morning, we also get GDP growth rate quarter over quarter, final numbers for Q2. We're expecting 3%. We could come in a little bit lower than that, but again, it's an election year. I don't think there's going to be dramatic weakening. I don't think we're going to come in negative or anything crazy like that. We're going to be in the twos at the bare minimum, like 2.5, 2.6%. 2.5% would be a disappointment for markets with 3% expectation. So do keep that in mind. I'm not as worried about the GDP growth rate. I think the durable goods orders could come in a little on the lighter side. We will also get tomorrow morning initial jobless claims, part of the post-Fed rally that we have seen in markets, post-Fed 50 basis point cut rally we've seen in markets, I should say, was because initial jobless claims, that first reading that we got last Thursday, came in at 219,000. We were expecting around 230,000. So that was 11,000 lower than expected. If you do see these start to move higher again, that's going to become problematic. We are expecting a rise to 225,000, but really anything like 230 plus thousand, Wall Street's going to start paying a little bit more attention to. Now, you get a lot of other data as well: corporate profits, PCE prices, continuing jobless claims, durable goods orders, excluding defense, expecting that's going to be a little bit more negative, to come in at negative 3.5%. Last month was positive 10.4%. GDP sales quarter over quarter, real consumer spending quarter over quarter, final numbers for Q2, expecting that at 2.9%. That's one that I will be paying very close attention to, but I don't know if markets will exactly pay attention to that. Now, we do have a speech from Fed Jerome Powell tomorrow, and this is the first time we're going to hear from Powell since that 50 basis point cut. Now, I will tell you right now, I think Powell is going to be very bullish. I think he's going to be very dovish. It's going to be a lot of the same stuff that we heard at, the podium just a week ago. Not much is actually going to change. Now, whether or not he says more tomorrow, I think is the bigger question. Whether he elaborates more, provides more details, sounds maybe a little bit more defensive or cautious on the economy. During the conference a week ago on the podium, Powell sounded about as dovish as you could possibly be. I don't think he's that optimistic about a soft landing, and we will see if he does try to paint a little bit more negative picture, because the Fed really just wants to bring down treasury yields. Okay, now the Fed cutting rates 50 basis points, I think they thought that they were going to bring down 10-year treasury yields and provide more accommodation to the economy. That did not happen. So if that's the Fed's goal and that didn't work, then what's the alternative? Well, the Fed's going to have to cut rates more. So the Fed's Powell's either going to boost those odds of a 50 basis point cut, or talk down the economy a little bit to show a little bit more concern about the labor market, which will bring down treasury yields and force markets to price in more aggressive Fed policy. So I guess it kind of, completes the same goal, if you will. But I still think Powell's generally going to be pretty bullish tomorrow. And I think that's already priced into markets. I think we're already kind of expecting Powell's going to be bullish. So if he's not as bullish as we think, then maybe that could be a downside risk for markets. But as far as the upside, I think we're kind of already expecting, again, Powell's going to be very dovish. On Friday, we have core PCE month over month, expecting that at 0.2%. Fed Waller said this could come in lower at about 0.14%, which would get revised down to 0.1%. So we have low expectations for PCE on Friday. Personal income month over month is expected at 0.4%. Last month was 0.3%. So if we get a number like that, that's going to be great news. Personal spending month over month is expected as 0.3%. The higher, the better; the lower, kind of the worse it's going to be, right? So you want to see personal spending come in good. Same is kind of true for durable goods orders, right? They're kind of the same, although personal spending's a little bit more broad. Durable goods orders is kind of spending on durable goods, right? Things that come and go. It's kind of implied in durable goods, right? So it's kind of the same metric, just a little bit different. And you want to see these come in, as high as possible. Like, there really is no negative. The higher, the better. Now, with that said, tomorrow's data is going to be so important because we did get that 50 basis point cut from the Fed. Historically, that's actually the moment you want to start panicking, is when the Fed starts cutting rates, especially if it's by 50 basis points. And here you can see from this post from Hendrik Zaberg that says the soft landing narrative is hopeless. Just observe data and study history. Recession or hard landing occurs when yields plummet and Fed cuts while unemployment moves up and we have yield inversion. Now look at the one soft landing and the hard landings and tell me which scenario we are in now. Soft landing, you had Fed cuts where unemployment was falling, was falling. And as unemployment moved higher, we went into a recession, right? This was in the 2000s, 2001s. But 1995, we had no yield curve inversion, right? Fed was cutting with unemployment rate that was falling. Hard landing, you had Fed cuts, but the unemployment rate was already starting to move higher, and we had yield curve inversion. 2007, Fed was cutting rates as the unemployment rate was already moving higher, and we had yield curve inversion. Even 2019 for that measure, we had Fed cuts, but the unemployment rate was moving higher, at least a little bit, right before the Fed started cutting rates. And we had yield curve inversions. And now you have a massive yield curve inversion. And what happened? Well, Fed's starting to cut rates now, and unemployment rate has dramatically moved higher. It doesn't take a genius to figure this out. And I don't think that's why, big money is not positioned super aggressive to the upside. And that's why today's downward price action is so small. Even if we do get bad data tomorrow and big money was leaked that bad data, they don't have to do a lot of repricing or hedging for the downside because they're not all exposed to the upside. For this post from Robin Brooks, this says global recession risk is rising sharply. The forward-looking orders and inventories component, orders minus inventories component in the S&P Global Manufacturing PMIs, is going negative all over the place. For the US in red, it just fell to a more negative level than in late 2022, right after Russia invaded Ukraine. This was also when inventories had risen in 2022 after that initial boom of building things, making things, and that's where we got that technical 2 declining quarters of GDP growth, which was a technical recession in 2022. So you're even worse than that now. And as I mentioned earlier in this video, you can see here from Michael J. Kramer on X, earnings estimates for 2024 and 2025 fell again today for the S&P 500. I guess we will find out really soon if fundamentals really do matter. My guess, they do. And you can see the earnings estimates fell a couple dollars, $2 or so from what I can view, from about 276, 277 down to 274.42 for end of year 2025 estimates, and markets have not reacted to that yet. So that's really why I want to ask you, do valuations even matter anymore? Or is the market so disconnected from reality that maybe even valuations don't matter, at least in the near term? Let me know your thoughts around all of this information down below in the comment section. I still do think September is going to be good for markets. I think the beginning of October is probably going to be good for markets. At some point, we will likely get some kind of election correction, but I think that's second half of October, and then I'm more worried about after the election, November, December, January, February, March of 2025. As I have explained here on this channel many times, that's when I think a larger decline for markets. So with that said, you guys have a great rest of your day. Hopefully you learned something from this video, and I will see you in the next one.